Larry Berman here. Fed week is over. The uncertainty is behind us, but is it? So, what did we learn this week? Well, let's take a dive and look at the dot plots and see if there's anything there. So, Powell in his presser was very clear when answering some questions on, what the dot plots actually mean. And it was, this is their best guess on where they think things should be, not will be. And again, it's a forecast. Forecasts are uncertain. But what's interesting about the new member of the FOMC, Stephen Miran, was that, it's clear that for the end of 2025, he's got an expectation that the target would be 275 to 3. Completely out to lunch from reality of where everyone else on the committee is looking at 1 or 2 cuts by the end of the year. So, median forecast here would be for 2 more cuts compared to last meeting and the update of the dot plots. No significant change. And so when we look into 26 and 27, clearly there's a move lower for rates. And the committee is recognizing, of course, that the weakness to the economy relative to inflation is a little bit more tilted. So they need to add a little bit more accommodation. Some, certainly not all of the uncertainty related to what is going to happen with tariffs is in the rearview mirror. There is still pretty strong concern from how I look at things anyways, that the inflation numbers are going to continue to uptick well through 2026. So there's probably only a limited amount of cutting they can do unless, as we've said before, the labor market comes unglued. And we start to lose jobs in the States. Weekly claims this week, previous week had jumped significantly up, kind of came back into the old range of the last few months. 1 week does not a trend make, neither on a breakout nor a correction. So more time is needed on that front to see how that all plays out. But it is clear that the labor demand story is softening. And that's what the Fed really recognized in their movement in the dot plots. Many or most are still very concerned about the inflation outlook. And so while we look at where rates can go, it's clear sort of the longish target is closer to 3 for neutral than and so while they haven't abandoned their 2% long-term target, it's clear that it's higher than it used to be. And that's probably one of the big messages. Now, of course, after May, Powell is no longer the chairman. We don't know yet who will be the chairman, but we can bet it's going to be someone with a more dovish tilt. Will they have enough influence on the broad committee to get them to move more aggressively? Yet to be determined. So from that perspective, the questions will continue to be asked. Let's look at the real markets and the response on the week just before and after. When I look at broad commodity prices and I think about market cycles of growth and economic contraction. We saw with the boom in fracking that there was a huge disinflationary impact broadly on commodity prices. This is the Bloomberg 28 basket broad commodity index. Energy is an influence here without a doubt. But as supply increased in the energy output of the US, you had definitely a big move down. For the rest of the decade, obviously COVID, negative prices, but for the rest of the decade, commodities were a non-factor in terms of the inflation rate. And when there's no inflation, that's wildly bullish for asset markets. Supply constraints, commodity prices go up, and Russia, Ukraine, boom. And then as that sort of settles in and the world oil markets rebalance a little bit, you get a new level. But now it looks like this new level of commodity prices, relative to the last decade, is a good chunk higher. That's not annual inflation. It's kind of a one-time reset. So, is it just a one-time thing, or is it something that is more permanent on in terms of goods prices? And I suspect we're still range bound here. When we blow this up a little bit and we look at the current market, oil prices uptick a little bit. We got a swing higher in the broad commodity index, post FOMC correction back to the mean. And so, the commodity basket is telling us from a good standpoint, we don't need to worry about inflation. Where I'm most worried about inflation is not on a goods basis, it's on a wage basis. And so paying attention to the labor market and what's going on there for me is really important. When you think about big tech and wage cost, definitely a factor, but they use fewer people to produce the output of goods relative to traditional manufacturing. A lot of the re-onshoring is of manufacturing, computer chips, Intel story this week, big part of that. But those are materials intensive facilities. They're not human intensive. There's a lot of robotics there. It's not Joe Plumber, so to speak, on the line cranking widgets, right? So a lot of automation in that aspect of bringing that back on shore. I think it's interesting for sure. When we talk about bringing the good manufacturing jobs back, again, a lot of those are automated. We'll see where labor inflation goes, but definitely a one-time uptick from the 2 to 3 range is probably more sticky than many would like to believe that are more in the disinflationary camp. Again, it's a debate for sure. I'm not necessarily right on this. I could be very wrong, but that's sort of my thinking. When we look at what the average stock did this week into the FOMC and out of the FOMC, the equal weight S&P 500 week on week was completely flat, with a lot of volatility around the event and a failure for the average stock to do much this week. When we look at small caps and the Russell 2000 and the small cap names that would otherwise benefit from falling rates, we saw more of a trend type movement. When we look at the NASDAQ, that again benefits more from lower rates, in the sense you saw more positive movement there. On the front end of the curve, we obviously saw some movement, but the Fed wasn't more bullish than was already priced in. The bond market and the long end was thinking harder economic landing, and based on Powell and his comments about insurance, I think in particular, that cooled off some of the risk here in terms of the bond market starting to price in a harder landing. And so we saw the long end of the curve come back a bit. Again, supply coming there, absolutely. The more the governments and the big beautiful bill and everything is willing to spend to keep the party going, the more the long end is going to struggle. The more the Fed has to cut, the more the long end is worried about inflation. And so, as we've said for quite a while, the long end is pretty much anchored. And so bond volatility in the MOVE index has really come off dramatically because the market's less worried about inflation. The market is not worried about trending in terms of a terribly weak economy that would indicate recession at this point. So we're still very much in a data-dependent flow. And so when we look at what's priced into the market, rate cuts coming into next year, but really 3 or 4 cuts, not 5 yet. And then the curve is priced towards tightening again. So long-term inflation expectations higher, some stimulus from rate cuts now. Net, that's bullish for assets until it isn't. And the until it isn't part is the labor situation. And for right now, we're okay. So, as much as the equity markets are, in my opinion, crazily overvalued here, it looks like it's still going to keep grinding on our face here. So that's really what I think I took out of the market noise this week, and just sharing it with you. Just a wish to everyone celebrating the Jewish New Year this year, and including myself, my friends, close friends, and family. Really looking forward to getting the whole family together this week. And so hope everyone has a great one that celebrates. Otherwise, we'll see you next week.